Hey everybody, I just want to thank you guys all for joining us today. This is number 6 in our strategies for any directional bias. Basically, anytime we are looking at the charts or we are looking at the platform that you may or may not be using, maybe it's the news, you come up with a directional bias in something. And that's usually the first thing that we come up with that leads us into the directionality of any given strategy. Well, the beauty in this one is the market can shoot up or it can shoot down. We don't have to be exactly spot on our directional bias. We just have a bias that, hey, you know, this has been stuck in the mud for a little while. Maybe we think it's going to break out because we saw something on the news or maybe earnings coming up or something like that. So the Long Iron Condor, although it isn't one of my favorites, it is really a great strategy for the type of environment we've been experiencing lately. So it is very pertinent for the Long Iron Condor right now. But one thing I also want you to kind of forget about is the fact that this is the Long Iron Condor webinar, okay? Because I want to go through it like any given day that you and I are trading and wanting to come up with some kind of strategy to take advantage of our bias, okay? So with the Long Iron Condor, it's a relatively easy strategy to build, to understand how to build this strategy. That's not the important thing I want you to take away from this. Anybody can teach you how to build a strategy. What I want you to come away with after this webinar is how to implement that strategy. That is the key to the success of any trading strategy, you guys, is how you implement that, all right? Because I have specific rules in and around this strategy and every strategy that I teach to increase your probabilities of success. There's times where you can be directionally right with option strategies and actually still lose money. What I'm here to do is to teach you those pitfalls so that you can avoid those going forward. And that is what makes the way I teach completely different than what everybody else is going to teach. They're going to try and teach you directionality, and this strategy used here, we would have made so much money on the return, okay? What I'm here to do is to tell you we need to set these strategies up with the right environment so that we can actually be a little bit wrong and still make money, okay? But let me get a couple of things out of the way real quick. My name's Eric Wilkinson. Some of you may recognize me from mainstream media. They used to call me the Wolfman. And I actually started out trading in college with some money I had earned, and then after graduating, I moved to Chicago and started trading everything from stocks, financial futures, commodity futures, currencies, and options on all these products in just about all market conditions. Yeah, one fun fact about me is after graduating college, I never filled out a resume before I started working on the floor. I just kind of showed up and asked who was hiring and ended up getting a job. Started out as one of those runners and then moved into the pits and have been trading my own money ever since basically college. Anyway, this says any opinions, news, research, and analysis or other information should not be construed as investment advice. It should only be considered general market commentary. And please remember, past performance of any trading system or methodology is not necessarily indicative of future results. Please pause and just kind of read over that at your own leisure. Anyway, moving on, Twitter, you can follow me at Wolfman's blog or our parent company at ProTraderStrat. Also, our Facebook page is out and it is ProTrader Strategies on Facebook. You will get access to daily market commentaries and all kinds of other market wisdom from there, so please follow us on Facebook. Like I mentioned, this is the Iron Condor, and one thing that I want to go into this webinar thinking is we don't know we are doing the Iron Condor at this point, all right? At this point, all we have is a directional assumption. But actually, I'm going to have to go over how we build this thing out before we really get into it. Anyway, the long strangle we've kind of already covered, and it's buying an out-of-the-money put and an out-of-the-money call. And if you guys remember during the webinar, I was saying we're looking at the 30-ish delta, and then we kind of build it out from there. Well, when we build out the long strangle, it's going to look like this. We are going to define this a little bit with the Long Iron Condor by selling a couple of a call and a put here, all right? So it will define it. We won't have that unlimited to the upside here. We are going to cap ourselves out right in here, okay? So when we do that, what we're doing is we're still doing those out of the money calls and puts, but with the Iron Condor, the key is we're selling a further out of the money put and a further out of the money call. Now, why would you want to do this rather than just building it out as the long strangle? The reason why is, for the most part, our break evens. We're going to try and bring our break evens in, whereas before our break evens were much further out. So our break evens are going to come in a little bit. So this is going to give us a little bit more wiggle room in case we're wrong and we don't get that outside move. We also are, the bottom line is how much money we are going to lay out for this strategy is going to go down. So we're going to have less money outlay. We are not necessarily going to increase our probabilities of success, but we are going to increase our ability to break even anyway. All right, so that chances of that happening are much better. Also, the fact is we are going to be selling with this one. It's going to be very close to like a 16 delta, okay? And as you guys know from my other webinars, that 16 delta means it's basically a 16% chance that these short calls will be in the money at expiry, all right? So by the expiration date, we only have about a 16% chance of being in the money there. So why not sell those? The probabilities are pretty low, and it increases, or it inches in our break even. So that is the benefit of this. So when we were looking at the strangle, we had to have a pretty good idea that there was a big move, in the near future. This one's like we're kind of speculating on it. We're not so sure. Maybe we didn't hear anything on news or have a great assumption, but we just think that this thing has been stuck in a sideways trend. The market's kind of been trading like this, and we expect either an outpaced move up or an outpaced move down. Now, we don't know. We just, one of my things is anytime you get stuck in a rut like this for very long, the longer you're in this, the more probability is that we're going to have an outpaced move, all right? And the longer it's stuck in this trend, the bigger the outpaced move, okay? So that's kind of my theory with this one. If it was a super long one, maybe I'd go with the strangle. If it's just been in there for a shorter period of time and I expect that move to blast out or above, then that's when I'm looking to implement this strategy. And like I showed you in the previous when we did the strangle, our Analyze tab is going to look more like this, all right? So again, we are still going to be starting out with around that 30-ish delta. We might have to move it in just a little bit, but we are going to have similar to those other rules. And one of the best advantages is the break even coming in a little bit closer, all right? All right, everybody with me so far? All right, good. All right, so, like I said, when we're picking the Long Iron Condor, before we really even get here, when we're looking at this, we have that outpaced move happening. Picking the right underlying. This is really important. Why? Because we've not come up with the Long Iron Condor yet. But what we have done is we've come up with our assumption. We've got an assumption. We got an assumption that there's a big move happening, right? So on this underlying. So how do we know if this underlying is appropriate to trade stocks or options with that? Well, when we look over here at the platform, let me bring it up real quick, pull it over, if I can drag it off of being expanded too big. All right, so we're going to come over here. And just for lack of a better example, other than McDonald's, it's on here, right? We could take a look at McDonald's. It's already had that move, so we might not have this necessarily assumption. But if we were looking at McDonald's for picking the right underlying, my rule is any stock that is over $100, all right? So this being a $200 stock, it's over $100, so we need to move this decimal place 3 ticks to the left. So we go 1, 2, 3. All right, so there's our decimal place, and we're kind of looking at 21 cents for that kind of rule. Now what I need to do is go down here and look at the options with that are the spot month, the closest to expiration. Yes, one could say that the September with 10 days is the month that is closest to expiration, but the idea is you want to kind of go to the ones that are 35 days to expiration. And the reason why we're going to that 35 days to expiration or closest to is because, if there's only 10 days to go, a lot of people are moving their money out here. So we want to go where the money is or the eyeballs. So we want the eyeballs on our market, and I would say that the eyeballs are looking at this probably 38 days to expiration, okay? So 21 cents is what we came up with. And this is during open market operations. Right now, we're doing this after the close, and a lot of our orders get canceled, right, at any given time. So we want to look at these ones that are just outside the money and make sure that from the bid to the offer, they are inside of 21 cents. And as you can see, even after the close, right now, McDonald's has pretty tight markets. You can also see good amount of volume, good amount of open interest on both sides. So that is another key. We want good volume and open interest as these eyeballs start coming in here. The reason why is because, if there's a lot of eyeballs in here and I come in, maybe I'm 461 cent bid. I changed my bid here. I make it 461. So I say, oh, you know what? Now I'm 461 bid. All right. Well, now this guy might come in and say, yeah, you know what? I see somebody coming in. He's a little bit interested. I'll give him a better offer. And he goes, I'll be at 478. All right. Well, then somebody else might have seen me beat their bid there. And all of a sudden they say, well, I'm 462 bid now. And he outpaces me. Now it forces me to leapfrog him or join him on the bid. So that free market price, what we're looking for is free market price discovery in full swing. And that's what happens when you have a lot of eyeballs in there. I'm happy if I'm at, if I'm on these puts over here, I'm happy all day long if I am $1.54 bid and nobody else joins me. As soon as somebody comes in, sorry, I said $1, I meant $1.54. As soon as somebody comes in and bids $1.55, I'm kind of like, shoot. Now I'm off the market, so I might either join him or make the market better to try and get my order up front. All right, so that's the kind of what we want to see. If there was only one person's set of eyeballs, we only got one set of eyeballs in here, kind of looking at this, that guy is not going to change the market. It's basically you and him, and I come in $1.55 bid here on the puts. I'm basically saying, you know what, I'll be $1.55. Well, this guy might even go, hey, you know what? He came in, now I'm $1.63. Because he knows he's the only cat in town. He knows he can make that market. He's kind of like, you know what, you got to come to me. I'm not giving up any edge. All right, so we need to make sure we avoid that by staying in markets that have tight bid asks. And what we're doing here on any stock that is greater than $100, all right, that $100 stock, if it's a $100 stock, then we move this decimal 1, 2, 3, and you would get then 10 cents, okay? We would need these to be equal to or less than 10 cents wide to the bid offer. Now it's a over $200 stock, so we don't have to worry about it. If it is a stock that is under $100, then any stock that is less than $100, all right, then we need it to be equal to or less than 10 cents wide to the bid offer down here, okay? And you can see Merck right now is not fitting that rule. We are about 12 cents. or about 13 cents. That starts working, but make sure that this is applicable during the day session, okay? But you can see here, even though these markets are pretty wide compared to what I was talking about, there is a lot of volume and open interest going on in here. As a matter of fact, 10,000 contracts today alone is a lot to move, all right? So that means there has to be volume and open interest. There's now going to be a lot more open interest tomorrow. There's going to be over 12,000, open interest there, which means somebody has a vested interest in watching this. And when he wants to get in and out, he's going to be willing to give up an edge or step over somebody else to make sure that his order is in place or up front, okay? So when you have a lot of volume, like we're seeing here, and you have a lot of open interest, that will equate to fitting to my rule, okay? That equals good markets. Same over here. You can see good volume and open interest. So that means we are going to have good markets in here. So we got that, right? We are looking for the right underlying. If it's greater than $100 stock, $100 stock, then we go and like that $100 stock, we move the decimal 3 ticks to the left, all right? And it's got to be less than whatever that number is, all right? And then on anything that is a stock that is less than $100 stock, all right? If it's less than $100 stock, then it needs to be equal to or less than 10 cents to the bid offer, all right? Pretty easy. That's the first thing and the most important thing. The reason why is because, especially if you're newer to options trading, then it shows you where the real bid offer should be. If you're getting into something like Aon, they have really wide markets in there. There's not a whole lot of eyeballs in there. And the idea is, I really don't know where I'm going to get filled, other than maybe on the offer, because that guy's not going to give up the edge to me. He knows that you have to come to him. That's one of the beauties in being a market maker in a very illiquid market, is because I know that I have risks of offsetting and stuff like that, so I'm going to make you come to me because I have inherent risk involved in trading that underlying as well, and I'm going to make you pay for that risk, is really what it comes down to. So stay away from that. Get in where everybody's trading so that you can not have to give up too much edge, all right? Because that eats into your yield overall, right? At the end of the day, you will, if you give up 25 cents to get in and 25 cents to get out, well, that means you probably had to be in that trade for 10 days just to break even on that edge you had to give up on trading, okay? So stay away from that. Get in where everybody else is playing. All right, now with the Long Iron Condor. Now again, we're not necessarily coming in this like saying, hey, I need to build a Long Iron Condor and I need to go through these steps to find out how to implement that in my strategy or in my portfolio. Yes, you may be in a situation where you are way too many you have way too many credit spreads in your portfolio and you're thinking I need to add some debit spreads to my portfolio, or you're worried about this big outpaced move, so you want to put on a hedge, a portfolio hedge, which is what this could be as well with the strangle. Great portfolio hedge if you get those big, huge outpaced moves and you know your portfolio isn't set up for that. That's a great way to add some hedge to your portfolio that's that way. All right, but picking the right environment, when we're doing the Iron Condor, we want IV percent. I'm going to talk about this a lot. IV percent isn't just implied volatility, all right? It's not implied volatility. It's not the VIX, all right, or the VXX. It's not the VIX or the VXX, okay? It's none of those. Implied volatility percent tells us where volatility and I'm just going to abbreviate it. Volatility is in relation to where it's been in the past. All right, so implied volatility is forward-looking, meaning the expectation of future volatility in this underlying, but every volatility, every underlying has a tendency to see their volatilities kind of do this. They stay within a certain range-bound area, and I can show you that on probably even McDonald's, which was the other example we had up here. So if I just even go over to McDonald's here, you can see that the extreme highs in volatility for McDonald's comes in somewhere around 32. The extreme low in volatility is somewhere around 14, right? And usually it wants to stay in between that. And that's what we like to trade against, is when we see volatility at its extreme highs, we know it wants to migrate back to the mean. Just like when it's extremely low, it wants to migrate back to the mean. So that's kind of how we're playing this, is that reversion back to the mean, or a volatility crush event, or an explosion in volatility, those kind of things. The only way to really know that is when we start seeing this stuff at somewhat of their extremes. Now, just because, you know, this in the past has been the extreme doesn't mean that we can't go a little bit higher than that. Yes, that can happen. And there's no way around it. We can't predict. It's like picking tops and bottoms in the markets. We can't always predict that. But what we can do is set ourselves up for success ahead of that. And that's really what we want to do. So for this rule, what we're going to be looking at for picking the right environment is we want a low IV percent. We want low IV percent here. And in that, we want, for stocks, we want this to be a less than a 30 IV percent. Okay, less than 30 there for stocks, and less than 15% for ETFs, right? So when we're going through this, again, I have XYZ as the stock. I think there's going to be a big move in either direction. I don't really know. So, but in order to implement the Long Iron Condor, we need to first know if it's a good underlying. Now, all of a sudden, we see XYZ stock has less than an IV percent of 30. And I see a couple of questions coming up. What is IV percent? So we're going to do that right now. How to figure out IV percent. What we need to do here for IV percent is we take the current, we're going to take the current implied volatility minus the low implied volatility, and we're going to take that sum and we're going to divide it by the high IV minus the low, low IV. All right? And those two sums, we're going to take those two sums and divide them by each other. All right, so let's just pull up this example real quick. Let's just pull up one in relation to where we're going to be kind of looking. I'm just going to look at Twitter. All right, so we can see Twitter's high, is in the 90s. So let's just call it 90 for math. High is 90, current is 37, and the low is 26. So 90, 37, 26. So we got 37 minus 26, because that's the current, 37 minus 26, and then the high, which was, we said 90, minus 26, all right? So we got 11 divided by, what is that, 64? 64, all right? So we divide those two by each other, and we are going to come up with somewhere, trying to do the math in my head right now, it's going to be somewhere around 15, I think. So we're going to take 11 divided by 64, 18, equals an 18%. Okay? So that means, really, all of that means is we're at extreme lows in volatility for Twitter, 18 implied volatility percent. You can see over here they have 15.51, and that's because the code I have put in here calculates it out to the very decimal. Like, you know, this is probably closer to 91, and those numbers are a little bit different than what I was punching in. All right, so there's variance there, and we don't have to have the exact. Okay, we just need a bit of a ballpark as to where it is. Currently, this is a forward-looking, saying volatility going forward doesn't look like it's going to be there. But we want to see where this is in relation to where it's been in the past, because you can see that it's pretty range-bound. But the reason why we can't just look at this number over here as 37, 37 doesn't tell me anything, right? If it's high or low. Because if I go over and look at something like what we saw before with McDonald's, McDonald's, its extreme high is 31. It never gets as high as Twitter's, current is right now, all right? And it's usually way down here, so 15 to 30 something, all right? So relatively tight range, okay? So utilities will have a tendency to be maybe even lower than this. So what we want to know is where this IB number, this implied volatility number for McDonald's is in relation to where it's been in the past. That number right there, or the number over here in the option montage, doesn't tell me anything. It actually does tell you a lot of things, don't get me wrong. Doesn't tell me anything as in, is this high or low for McDonald's? Is what I want you to come away with there, all right? So you can see the IV percentile down here with the rounding and stuff like that for McDonald's is 19, all right? It'll be a little bit different than what it is over here because of the rounding and stuff. So McDonald's, we know, as low implied volatility as well for this. All right, so that is picking the right environment. All right, we need low implied volatility percent, and we want that to be less than 30. Like I said, less than 30 for stocks. There we go. Less than 30 for stocks and less than 15 for ETFs. The reason why ETFs are a little bit lower is because there's a basket of goods there, right? And that basket of goods, all of those implied volatilities will meld each other out a little bit. So we need to shoot for a little bit lower when we're buying options with ETFs. I don't know why that came to that one. Oh, I know what I was going to do with that. And the reason why we want that low implied volatility percent, and I understand that this is not the Condor here. We need to have some defined risks on this, all right? That's not really what I wanted you to come away with here. What I want you to come away with is, like, this is a $60 stock, and this is, let's just say it's XYZ, all right, is a $60 stock. And when XYZ has low IV, all right, implied volatility percent, when it has low implied volatility percent, you can see my strike locations are basically looking at 57.5, and over here we're looking at 62.5. All right, that would be where my strike locations are. That's around that 30 delta we were talking about, right? 30 delta there, 30 delta here, and I'll go into that a little bit more in a minute. But 30 deltas is where we would look at it. Well, now when it has high, now we have high implied volatility percent. You see why I don't want to be buying this strategy now? My strike location is 50 and 72. 50 and 72. Now, one thing you might notice is it's still a 30 delta. It's still going to be a 30 delta with that high implied volatility, because volatility, what it does in delta is a product of that, right? And when volatility is really high, that's saying right now the expectations of these moves are this, and the probabilities of that happening are the delta. Well, it's saying the probabilities of it trading out to 72 and 50 is about 30%. It's still 30%, but the implied volatility is higher. So that's why IV percent is key. We want to get into low implied volatility percent because that means we're buying cheap options. I think it's an A, cheap options. All right, we're buying cheap options right now. It doesn't matter that how much you're paying for it. You just know when implied volatility, IV percent, is like this, that's about as cheap as you're going to get. All right? You're going to be, with the same strike locations, you know, this is as cheap as it can get. And that's what we want to do. Not only do we know that our strike locations are coming in, the lower the volatility goes, it means that, you know, we don't have to have much of a move to get to our break evens now either. Okay? Now, picking the right duration, we want to be we want it to be greater than 50 days to expiration. All right? All right, we talked about this. We need the less than 10 cents wide kind of thing, right? We've got the environment. We know it's got low IV percent. So we're just checking these things off as we go. Now duration, we're starting to get that. If it's got low implied volatility percent, then it leads me to, I need to go further out the curve. Why? Because when we see options decay, inside of this area, we get much steeper decay going on inside of that 30 days. But look, I'm saying go outside of 50 days, and you can see that the curve is much less. And even further out, it goes a little bit flatter, right? So we're buying this. We want to pay very little for it. Now, I don't like to get way out here either. I mean, you can go out there. It's just you are going to pay a little bit more money, and that is all due to basically theta decay and stuff like that. You know, one could say the further out you go, we got volatility helping us out. But my sweet spot I like for this strategy is outside of 50 days and somewhere in that, you know, 80 to 50 days really. 100, sometimes 100 days is where you have to go. All right, sometimes you have to go out to that 100 days, but I don't like going much further. I kind of put a line in there. I'd like to rather not go any further out there, but some options don't have that 80 days. They'll have the ones that are about 40 days. They'll have these strike locations, and then the next ones they'll have the hundreds. All right, so you're going to have to look for that. But sweet spot for me is right here, and the reason why is because theta, the thief in the night that comes and steals our premium, is pretty slow. He's pretty nervous. He doesn't like to take a lot of premium, but inside of here, he knows like you're getting ready to move out of town, so he's got to get busy. All right. And I don't want to be inside of this last 7 days at all possible because of that theta component. And you know, if you're inside of that, you're probably already at a full loss. Is the way I would be looking at it. I wouldn't be taking a profitable trade that far into it. I don't ride these out to the end of the day, you guys. So like when we're talking about break evens and stuff like that, I'm not worried about that because I'm almost never going to be holding it to 0 days unless it was a full loser right here or something. Okay. So outside of 50 days to expiration, and we kind of talked about this. We're going to be looking at the 30 delta, all right, in the option montage. But we're likely going to have to be, it's a 30 plus delta. I should actually do 30 plus delta, okay? It's going to have to be a little bit more than that. And our thing though, when we're building this out, we want to risk one to make one. Okay, we want to risk one, risk one to make one. All right, so let's look at a strategy real quick. Let's try and pull something up and build this out for us. So we've got McDonald's, low implied volatility percent. Maybe you expect a big breakout. So this is what I was talking about. What I like to do usually is when we're looking at this strategy, you can see right here, this is one that I would be looking at. When you get those tight wound up markets like this, I expect a big outpaced move to happen relatively soon. All right. I've done this in the daily market commentaries recently with a strangle in Twillo, and I've got a Long Iron Condor in, I think it's Qualcomm. But you see the markets trade sideways like this, that's when you should be thinking, okay, I think there's going to be a big move happening, something like that. That's what I'm looking at. And the reason why I look at it like that is because I am thinking along the lines of the market is somewhat of like those old balsa wood airplanes, where you got the propeller and you wind up the propeller and it's twisting up that rubber band. Well, the more you wind that rubber band up, or that propeller, and it tightens up that rubber band, there's more pent up energy in there. All right. If I only wind it up 1 or 2 times and let go, it kind of just spins. All right. But I wind that sucker up like 20 times, that thing's got some pent up energy. Like the pent up energy here isn't as great as what we were seeing. The pent up energy ahead of that isn't nearly, this kind of pent up energy doesn't feel nearly as pent up as like this. That thing's ready to snap. But anyway, we are seeing volatility expand, which we want to see volatility expand in this strategy, right? We're trying to get in this with low volatility so that we can bring our strike locations in a little bit tighter. And with that expansion in volatility, remember when we saw the ones with the really high volatility, all of a sudden those strike locations went further out. We were, let me just pull it up real quick. Back here where we were looking at this, all right, the strike location is much further in. Well, when we get into this strategy with that strike location where we were talking about, what was it, I think it was the, 57.5 and the 62.5. So the 57.5 and the 62.5 are right there. So when volatility expands, it starts pushing out like that. Well, also, we start seeing this purple line move up higher also, which means we are already at profitability, okay? So that's something we want to see going forward as well. So when I'm talking, whoops, I don't want to go that far. We'll talk about the exit strategy in just a second. Oops, I don't want that either. Strike location is closer, right? We know we have low implied volatility percent. It's less than 30 for McDonald's. Move the decimal 3 ticks to the left. 21 cents. We see that fits the rule. Sorry, I got a yawn. So we're good to go to build out this strategy. Now, we said we were going to start out with looking at the delta. So we don't have the 30 delta here. It's a little bit funky. So let's go to something else. Let's just go to Apple. We expect Apple to have that big outpaced move. It's been stuck in a bit of a range, so we're thinking it's going to break out. So $200 stock, 21 cents. So you can see Apple fits that rule. That makes us good to go there. The duration we want to get rid of and go further out. We don't have that 70 or days, but we have 60. It's outside of 50. So we're far enough out, I think. And we're looking at the 30 delta. This one's closer. Usually you have to go in just a little bit, but we're going to go with this one and buy the, let's buy the 230s and then look for the 30 delta here and then we're buying the 205s. Now, somebody might say, yeah, it's not equal distance away and stuff like that. I'm not worried about that right now. I'm just worried about making sure my deltas are relatively the same. So any stock that's over $100, you usually are going to have to go $5 to $10 wide. I bet with this one, I'm going to have to go $10 wide, so I'm just going to start there. Because the one that you're selling also is usually going to be close to the 15 delta. But I'm just going to go just inside of that, or the 16 delta is what I meant to say. And then I'm going to sell that one. See, it's very close to the 16 delta just for government work. And you can see we've got less than 50% the width of the strikes, which is my rule. We want to be less than or equal to 50% the width of the strikes. I have $10 wides on the calls, $10 wides on the puts, and I'm paying $4.73. That means I'm risking slightly less than one to make slightly more than one. So, you know, I talk about in other webinars, if you watch those, where I talk about where you have, you know, your stop sign, right? And we have green lights, yellow lights, and red lights, okay? This is a solid green light. This is solid green light. Believe it or not, that's should be a green light. So we have a solid green there because our theory is we want to risk, you know, really less than one to make more than one. All right. And one thing to note, like with this strategy, guys, you can easily get involved in this strategy with really high implied volatility. And if you follow my rules on the width of the spreads and doing the debit and all of that stuff, versus everything else is going to work out quite nicely. And you're going to be like, holy cow, Wolfman, why do I have to be doing this in low implied volatility? It works out in the other ones. Well, we already talked about one. Your legs are going to be much further out. Like you would be picking like maybe the 175s and the 205s. Well, as volatility comes in, if we go over to the charts, you know, you can see when volatility is expanded, it has a tendency to crush out of it. It comes out quickly. We want to get involved in this type of environment because what happens is, when I'm talking about implied volatility, okay, on the Analyze tab, you can see my defined risk. I'm risking slightly less. The break even, let's just talk about that real quick before I get too deep in the weeds here. We bought the 230 calls, right? My break even is then adding this debit in to the upside. Anytime you're doing a debit, you got to kind of add it to that stock. So on the call side anyway. So 234.73 to the upside is my break even. So that should run, or sorry, 234.73. You can see down here at the bottom when I line it up. So 234.73 is really where the break even should be there. And then to the downside, we're going to be looking at subtracting $7.50, dyslexia. We're going to be subtracting $4.73 from my 205 puts that I bought. So you subtract that, we're looking at $200.27 is where my break even to the downside is. So when you look down here at the break even, $200 and should be 27 cents if I could line it up right. Okay, so that's how we figure out those break evens, our strikes here, and that's at expiration, you guys. That's how we get to that break even at expiration. But what can happen during the life of this, and if we do this when we have really low implied volatility and that volatility starts expanding for us, I want you to keep your eye on this purple line. What it represents when you get into this strategy, how volatility and everything else, price adjustment, affects your profitability. And we can see that as volatility starts coming in, we start getting more and more volatility. You can see that purple line gets up and away from this break-even line, which is on this horizontal line, means, you know, zero money made or lost kind of thing, going sideways. And we haven't changed the price. We haven't changed any other parameters, the date, we don't have theta coming into this or anything else, or stock price adjustments with delta. What we do see though, as the volatility expands, that market, that purple line is going higher and further away from zero. Meaning if I put this strategy on today and no time really passed and I got a volatility adjustment happening where volatility started increasing in this underlying, whether the market is going up, down, or sideways, I am already starting to be profitable. Like this strategy could now be worth, you know, with that volatility adjustment, it could be worth like $5.23. You know, I could get out for, you know, better than where I got in. Right? All just based on volatility expanding. So another reason why we want to get in with this at really low volatility is because if volatility expands, it will not hurt us. It will only help us. Volatility is going to affect further duration options and those options that are closer to the money. So the ones that we are long are going to increase in value. All right? These strikes that were long, the 230s and the 205s, those are closer to at the money, which means volatility affects them more. So as volatility adjusts, those premiums will adjust more. Vice versa, we don't want volatility to start coming out, because you can see that if I put this strategy on afterwards, I paid $4.73 for this, it might only be worth now, you know, $4.25. This price is going to continue to go down as I make that adjustment, all right, with this volatility. I would be able to pay less. But if I'm able to pay less now than I was before, that means I'm losing money, and that's going to be due to this volatility adjustment happening to that. And that purple line just represents what happened as volatility adjusts. Okay? So strike locations, we're looking at, again, we're looking at that, starting out with that 30 delta. We're buying about the 30 delta, and we're going to be selling somewhere around the 16 delta. All right? Which means we have a better than 30% probability of success. All right? So why is that? Because here's a little floor trader hack. Remember I said we're doing that with the 16 delta? Well, this delta also tells us it's a 16% probability, 16% chance of being in the money at expiration. All right? There's only a 16% chance of being, and that's our short, right? Well, 2 times delta is the probability, is the probability of being touched. Is the chances of being touched, all right? That means that where I was talking about, we're looking at the 195 strike, which is like right here, and the, what do we do for up the top, is 240 strike there. Well, we're looking at the 16 delta here. That means the market can trade, boom, 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 and hit that, and then come back down to here, right? Means the market just goes up there and touches it. Or we used to say on the floor, it would be like being kissed. Right? It's a probability of getting kissed. The market comes up, just touches it, and comes back down, comes away from it. All right. So we could look at it on the chart here. So we were looking at the 240s. 240s are up here, and the other one is the, what was it, the 200s or something, I don't know. Somewhere down here, let's just call it. All right, so this is saying in the next 50 days, we have 50 days that, or 60 days we were looking at, 60 days to expiration. And we're looking at that 16 delta, which I said is 2 times the delta, so we got about a 32% chance of Apple trading up like this and coming up and hitting it, and it might slam right back down to here. But just touch it one time, okay? So in that next 50 days from here to here, we got a pretty good chance of it just coming up and hitting it once, or coming down and hitting it down there. And that's all we're looking for, because I'm not looking to ride this out to the end of the day. I mentioned that at the very beginning. What I'm looking to do here, you guys, is to have an exit strategy that is beneficial to me. All right, so I'm looking to get out at 50% increase in my money. All right, so in that case, you know, if, you know, in that one example we were looking at, I was paying $4 and whatever, let's just say it's $4. If I'm paying $4 on this strategy, when this increases to $6, that's where I'm getting out. That's my exit. All right, 50% increase in my premium. All right, that's where I'm looking to get out. And if we go up there and we hit those short strikes, you are definitely going to be already at that 50% increase in premium. The only way to get all of this full boat on the other $5 on a $10 wide, or in this case, it would probably be an $8 wide spread. We collected $4 to risk one to make one. The only way to make that full amount of money is if we are outside of where our short strikes are at expiration. Meaning all the volatility is out, all of the theta is out, and it's just intrinsic value. All right, I don't want that risk. There's only a 16% chance one of my short strikes is in the money at expiration. All right, pretty low. But I've got a 32% chance, twice as much, of just being kissed. Which means if I'm getting kissed, I'm getting married. I'm getting out. All right, so that happens. You want to get while the getting's good. All right, so 50% increase in that debit paid is my exit strategy. We kind of already went over a couple of these with the max profit and stuff like that. The max profit is the width of the spreads minus the debit paid. So our example was we were looking at $10 wide strikes, right? Because it was like the 195 calls and the 205 calls, right? Is what we were looking at, buying these and selling these. So it's $10 wide between the two. So that's that, $10 wide. We were looking at paying $4.73, right? Which means my max profit is $5.27. All right? So that's the max profit, is a total of $5. And that means our spread would end up settling $10. I'm saying get out when this increases by $4, you know, so, you know, your max profit after you paid the debit is $5. So with me, I'm saying an increase of 50% in this one. So I'm looking at basically getting out at $7, is that right? $2 and let's say 35 cents. So $2.35, yeah, $2.35 puts me at $7 and, but let's just say $7.10 for math. So I would be getting out somewhere around there is where I'm looking at. All right, which means I profited by just slightly, you know, my profit is looking at $2.35 total. That's my profit. All right, I'm not looking at this max profit of $5.27. I'm looking at taking a profit of $2.35. All right. All right, your max loss is that debit paid. So in our example, we were looking at the debit paid of $4.73. That's easy. Anytime you pay a debit there, then that's what you're looking at as your max loss. All right. Break evens. We did this once. You know, we were talking about you take the long call strike plus that premium paid, or the long put minus the premium paid. Okay. So pretty easy to figure those all out. Does anybody else have any other questions real quick? You guys seem a little quiet today. All right, so let's just go over this one more time. Just as a last minute thing here. Let's just erase all that ink. So picking the right underlying, right? We either do one of two things, move the decimal place 3 ticks to the left, right, on a $200 stock or whatever, right? To get equal, it needs to be equal to or less than 20 cents in that. If it's a stock that's over, that's on a stock that's over $100, all right? We'd move that decimal. If the stock is less than $100 stock, then it needs to be equal to or less than 10 cents wide. All right. The environment, we need low implied volatility percent. And that means less than 30 for a stock. All right. Duration, we want greater than 50 days to expiration. All right. Picking the right strikes, we want to risk one to make one. All right. And then our exit strategy is a 50% increase in our debit. All right. Pretty good. Pretty simple. But when we, and then that, all of those things would say, hey, you need the Long Iron Condor, right? You've got the underlying, I've got a big outpaced move. The environment is low. Well, if it's got low implied volatility, that means I want more duration. I want to increase duration. All right. And picking the right strikes, we need to risk one to make one. All right. So a lot of these things will still work, but if you don't have the right environment, you are implementing this strategy incorrectly. And what did I say at the beginning of this webinar? Is one of the things, well, I didn't say this. One of the few things we can do with trading options is setting them up correctly at the beginning in the right environment, setting ourselves up for success, okay? We don't always get the directionality right. Even the guys on TV don't. They just don't talk about it when they're not getting it right. All right? They only tell you about when they're spouting off about how to implement a strategy incorrectly, which I even talk about that in other things. In daily market commentaries, you get all that stuff. All right, guys, this is the link to the webinar right here. Options courses, the option courses. This is options for beginners, all right? So if you're getting a little bit lost in this webinar, I'm assuming you have gone over some of these basic level courses where I talk about theta and we go and dissect theta. We dissect vega, gamma, and delta, all right? Even rho, which we haven't had to worry about lately. I go into all of those, the minutia around trading options. But for $36, you know, I showed them just the last webinar we had, how somebody was saying buy calls in high implied volatility environment, and I showed how in one day you would have lost that $36 on his trade and would have gained that $36 as a positive on my trade. So follow that, because you know, if you're watching guys on TV, I'm telling you guys, they do not how to really know, they don't know how to trade options, despite the fact that they say they made themselves on the floor a lot of times. But I talk about buy and call strategies, long call spread strategies, covered call strategies. If you have options in a portfolio, hedging risk, long put strategies, spreads, and protective put strategies. All of that and more in this. There's over probably 8 hours of content here. So take advantage of this, especially if you got a little bit lost in this webinar, so that you know you're prepared for the next one that we get going on, all right? And watch these again, because then it'll solidify it into your long-term memory. But for $36, there's guys out there that are spouting off, you know, when to buy calls and stuff like that, and they are telling you to do it in the wrong environment. And other webinars, I'm not going to do it in every single webinar, but in other webinars I've showed perfect, like, day of examples where somebody came out and said one thing and I said that it was incorrect, and then literally the next day I showed how that was correct. So follow that. Like I said, here is the link. If you're watching this live, you can hit easily on the link in the chat window. But again, if you're watching this on tape delay, just pause and punch this into your URL right now. All right? I want to thank you guys all for participating in this. Later webinars, I'm going to be drilling down on different option components when and where I find those appropriate. Again, there's the link. Thanks for watching. Please contact us at 310-598-6677 or trading@protraderstrategies.com. Yes, George, implementation is the key to success, right? Just because you know how to do something doesn't mean that it's all going to work out, especially in options trading. Just because you know how to buy a call spread does not mean that you know how to trade a call spread or how to implement that to the highest probability of success. And I think I've showed you guys enough here that that you guys should feel confident in going out there and taking advantage of this course for $36. Very little risk for the reward you will receive. All right, that's all I got for you. Other than, if you can't take that, take it easy. Thanks, John. Thanks, David. Appreciate all the kind words. Take care of you guys.